In a recent turn of events, news surfaced last week revealing a surprising ease in inflation for October, marking a potential conclusion to the Federal Reserve's robust rate hike campaign. The impact of this shift extends far beyond economic jargon. It paints a vivid picture of relief for investors and potential gains for the stock market and 401 KSE. The historical trend, as analyzed over the last 4 decades, suggests that post the final rate increase, the S&P 500 tends to soar, presenting a stark contrast to the turbulent periods of rate hikes. But amidst this optimism, questions linger: will this time be different, and what factors might steer the market in the coming months? Welcome to Global Economic Drops, where we bring you simple summaries of important daily and weekly economic news from around the world. Our mission is to simplify the economy and help you navigate the treacherous waters facing investors today. So before we get into today's videos, hit that subscribe button and turn on post notifications by clicking the bell icon. And if you find our news briefs valuable, don't forget to hit the like button. Leave a comment down below telling us just what you think is going on with the state of the world, and share this video with a friend or two so that you can all stay updated together. Thanks for watching, and now let's dive into it. The dynamics of rate hikes. In the world of finance, the Federal Reserve's decision to hike rates sets off a domino effect. It raises the costs of mortgages, loans, and credit cards, creating a ripple that dampens economic activity and nibbles into corporate earnings. Stocks, in turn, become less enticing compared to bonds, given the lower risk associated with a rising yield. The recent halt in rate hikes flips this narrative, painting a brighter economic picture and making stocks a more attractive investment. Yet, uncertainties loom. Will the Federal Reserve maintain this pause, and what if more rate increases are on the horizon? Market resilience and uncertainties. Examining the recent trajectory of the S&P 500 from the initiation of rate hikes in March 2022 to the present reflects a market grappling with fluctuation. However, the landscape shifted dramatically after a favorable consumer price index report, with the index experiencing a notable surge. Market analysts predict that if July indeed marked the last hike, a historically robust year for stocks could follow. Yet, cautionary notes are sounded. Fed officials haven't ruled out additional hikes, and history reveals that a pause doesn't always guarantee market stability. Factors in play: earnings, productivity, and stock valuation. Beyond the direct impact of rate hikes, other factors dance in the economic foreground. Earnings reports for the third quarter hint at the possibility of emerging from an earnings recession, potentially injecting vigor into the market. Productivity gains, driven by artificial intelligence, could further bolster the economy by allowing wage increases without price surges. However, a shadow looms over the relatively high stock valuations, emphasizing the weight on the economy and earnings to perform. The question arises: how will these complex interplays unfold in the coming months? Looking ahead, the Fed's role in investor expectation. As the narrative unfolds, the role of the Federal Reserve becomes pivotal. While a Fed on the sidelines might provide a medium-term boost to stocks, investor expectations for rate cuts could reshape the trajectory. The dichotomy between a Fed endorsing a higher-for-longer stance and the market's desire for rate cuts raises a poignant question: will the recovery sustain its momentum, or are there storm clouds on the horizon? Investors find themselves at a crossroads, contemplating the potential trajectory of their portfolios in the ever-shifting sands of the financial landscape. What is your perspective on the evolving relationship between the Federal Reserve's decisions and market dynamics? How do you foresee these factors shaping the future of your investments? Share your thoughts in the comments section below, and remember to subscribe to the channel to stay up to date on global economic news. See you on the next video, and please like and share if you enjoy our content.